attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the final segment in a multi-part securities law cast discussing reverse merger transactions. Today I will talk about the advantages and disadvantages of completing a reverse merger. First, the advantages. The primary advantage of a reverse merger is that it can be completed very quickly. As long as the private entity going public has its ducks in a row, a reverse merger can be completed as quickly as the attorneys can complete the paperwork. Having your ducks in a row includes having all the information to complete a Super 8K organized and available, including completed audited financial statements for the prior 2 fiscal years and reviewed financial statements for the quarters to date, or from inception if the company is less than 2 years old. Another benefit is the existence of a shareholder base. A shareholder base is necessary for a company to have active trading and attractive liquidity in its stock. The more shareholders, generally the more active the trading in the stock and the less volatile the stock price is from ordinary buying and selling pressure. In addition, a minimum number of shareholders, generally 300, is necessary to qualify to list on an exchange such as NASDAQ. Also, existing shareholders are often an overlooked but great source for capital raises via shareholder rights offerings. Another benefit is the existence of a trading symbol. Generally, in an IPO process, a trading symbol is not issued until the S-1 process has been completed and closed out, and a market maker completes a 15C211 application with FINRA. The 211 process can be lengthy and difficult. A trading symbol is a necessary precondition to a secondary trading market and a precondition for many active capital investors. Similarly, a trading history can be seen as beneficial. Although really any pre-reverse merger trading history should not be indicative of future trading activity, it does show how active the public vehicle shareholder base is and was, and experience shows that it is infinitely easier for an active trading market to develop where one has previously existed. Finally, since a reverse merger is a going public transaction, the newly public vehicle or newly public company will have all the benefits of being public, including the ability to use stock and stock options to attract and keep higher level executives, use stock as currency to make acquisitions, and of course to access capital markets and capital investors. Now the disadvantages of a reverse merger. The primary disadvantage is the restriction on the use of Rule 144 where the public company is or ever has been a shell company. Rule 144 is not available if the public vehicle is a shell company until 12 months after the filing of the Super 8K, and then only if the company is current in its reporting obligations. Even if the public vehicle is not a shell at the time of the reverse merger, if it ever was a shell in its history, it carries the stigma forever, and Rule 144 will only be available if the company is current in its reporting obligations. Of course, there is also the issue of undisclosed potential liabilities, lawsuits, or other issues with the public shell. Accordingly, due diligence is an important aspect of the reverse merger process, even dealing with a fully reporting vehicle. The third primary disadvantage is the reverse merger is not a capital raising transaction, whereas an IPO and DPO are. An entity in need of capital will still be in need of capital following a reverse merger. The next disadvantage is the immediate cost. The private entity generally must pay for the public shell with cash, equity, or a combination of both, and I've covered that in a previous lawcast. The next disadvantage is a trading history, which I mentioned as an advantage. An inactive or volatile trading history can repeat itself, just as an active and good trading history can repeat itself. The next disadvantage is that the national exchanges, such as NASDAQ, prohibit a reverse merger company from applying to the exchange until the combined entity is traded on the over-the-counter market for at least 1 year following the reverse merger, and the entity must remain current in its reporting obligations for that year. The next disadvantage is dealing with FINRA and DTC. FINRA can be very difficult when applying for a new trading symbol following a reverse merger. Also, concurrently with getting a new trading symbol or a name change, DTC will want an updated eligibility opinion letter, which may not be available if the public vehicle is a shell company. Finally, when an entity seeks to go public through a reverse merger or an IPO, they will be subject to several and ongoing time-sensitive filings with the SEC and will thereafter be subject to the SEC reporting requirements. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance. Should you have any questions about today's topic, please visit securitieslawblog.com or contact me directly. Inquiries of a technical nature are always encouraged.